Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on today's episode, I am joined by James Rickards, an investment advisor, lawyer, inventor, and economist, and a New York Times best-selling author of books such as Currency Wars, The Death of Money, and Money GPT, his latest. We are going to be discussing the current state of the US and global economy, why gold is such an important asset to hold in our current era, his outlook for silver, his thoughts on President Trump becoming elected and its implication for the economy and markets, and so much more. I hope you'll enjoy my conversation with James Rickards. So I want to start our conversation today with a broad question, and that is, what are you currently watching when it comes to financial markets and the economy that you think more people should be paying attention to?
Thanks, Jesse. Two things in particular. There are a lot of signs of recession or coming recession. Now, I know GDP was very solid for the third quarter, and Atlanta Fed GDP tracker was off to a good start for the fourth quarter. So I understand the data, but there are a lot of signs behind the curtain that some of them highly technical, and we can kind of explain in plain English. But I'm looking at, for example, as you know, there's a lot less there than meets the eye in terms of the monthly employment reports. There was a long string, it's kind of 12 out of 14, which is statistically, if not impossible, definitely extremely unlikely, of downward revisions where the report would come out first Friday of the month, prior month, so many jobs created, whether it's 200,000 or 300,000. And then the following month would come out. They say, well, now we created 250,000 jobs. But, oh, by the way, prior month, we revised down 80,000. It's like, well, wait a second. Your 250 was actually 170 and so forth. But that happened month after month after month. The Bureau of Labor Statistics did an annual revision, a major revision, where they wiped out over 800,000 jobs just as a statistical adjustment. And then when you combine that with the monthly adjustments, there were a couple million jobs that disappeared that we were led to believe were created at the time. And, analysts kind of caught on to this, and they gave it less and less credence. Now, the most recent jobs report, we saw that the reported number was 12,000, which is nothing. It's positive. And most of that, not most of it, but a lot of it were government jobs. And when you strip out the government jobs and say, well, what did the private sector do? It was negative. We lost jobs. So, and employment, as people know, tends to be a lagging indicator. So when you see trouble showing up in the employment markets, you may already be in the recession. You just don't know it yet. I mean, the National Bureau of Economic Research, that's they call kind of balls and strikes, and they're the ones who decide when a recession begins and when it ends. It's not a government agency, but they're all, it's like 12 or 14 PhD eggheads who, most of whom have been in government service or all in academia one time or another. But a lot of times by the time they declare a recession, it's already over. Meaning if a recession is 6 months or 9 months, and it takes them 9 months to make up their minds, it's like, well, the recession started, last January or whatever. Like, well, thanks a lot. We've been living through it. We think we knew that, but and that's okay. I'm not faulting them. I'm just saying that you can be in a recession, not even know it. You feel it. It might affect you or your neighbors or your business, but there's nobody waving a flag, saying, "Hey, it's a recession." And B, by the time the scorekeepers jump in, it could already be over. So that's one sign. And then within that, just to kind of parse the numbers a little bit, the vast majority of these jobs are going to non-citizens, some legal, some illegal, but none of them U.S. citizens. And they tend to be, not exclusively, they tend to be at the low end of the wage scale. So what's happening is, I'll refer to illegal immigrants in particular, these are the people working for $5 an hour. They're lined up on the expressway entrances, and you pick them up and they'll come, clean your yard or whatever. But if you have enough of those $5 people, the legitimate worker making $8.50 or $9 an hour can't get a raise. Like the $9 guy wants to get up to $12, but if there's a $5 guy waiting in the wings, you don't get that raise. And likewise, the $15 person can't get to 20 because these low income low-wage workers are dragging down the entire wage scale. And that, by the way, is one of the reasons why a lot of big, well-known companies favor all this illegal immigration, because they're the ones hiring, the if not $5, maybe $10 an hour people. So A, the labor statistics have been overstated. B, when you adjust them, the economy is a lot weaker than it looks. The jobs that are being created are going to illegal immigrants, and real wages are lagging. So all of this is very bad for consumption. People are just, if they can barely afford to, eggs, bacon, bread, gas, and groceries, and gasoline. The demand for gasoline is inelastic. Like, you need it. It doesn't. You want a lower price, but it doesn't matter how high the price is. You have to pay it because you have to get to work or take your kids to school or drive your pickup truck on business or whatever it may be. Then there are some more technical indicators, but they're there. We had, beginning about a year and a half ago, we had what's called an inverted yield curve. Well, what's that? Well, a yield curve is just a graph. The y-axis is is interest rates. The x-axis are the maturities of certain securities, particularly treasury securities. So 1 month, 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, all the way out to 30 years. And the curve generally goes up from lower left to upper right, which is what you would expect. You say, hey, if I'm going to lend you money overnight, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I want a higher rate because I've got risk. There's inflation risk and sovereign risk and a settlement risk and a lot of other risks, geopolitical risk, et cetera. So that's normal. But about a year and a half ago, the yield curve was inverted, meaning when you move from left to right, it was going down. Well, what's up with that? Well, first of all, it does happen. It's unusual, but it does happen. And when it happens, it's telling you something. I think, well, why would I take a lower interest rate on a 5-year note than a 4-month bill? And the answer is that I think interest rates are going to come down. I think we're heading into a recession. In other words, that I'll say, a 4% yield on a 5-year treasury note might look really sweet in a world of 2% interest rates or 1% interest rates. If you go into a recession, interest rates are going to drop a lot. They're already dropping at the short end. So I will take a lower yield, meaning the inverted yield curve. So when 3-month treasury bills were around 5.25, you go out to the 10-year note, it was 3.8, and it's higher now. It's about 4.25 today, but at the time it was kind of 3.8. That's the smart money saying, I'll take the lower yield because when we get further out the curve as time goes by, interest rates are going to collapse and that yield is going to look really good. Now, right now, today, as we speak, the yield curve is upward sloping again. In other words, it's a normal yield curve. It has uninverted. What does that mean? Well, the inversion was a warning saying the recession is coming. But now that it's uninverted, it's saying the recession's here. In other words, intermediate and long-term rates are not going up a lot. They've gone up a little, but short-term rates are plunging. And everyone's saying, oh, the Fed's cutting rates. The Fed's going to stimulate the economy with rate cuts. Nonsense. I mean, the Fed is cutting rates, but that's not stimulus. That's a sign of a very weak economy. When did we have low rates? Well, the Great Depression was one, and we had zero rates from 2009 to 2019, which was a long recovery, but a period of very, very weak growth. Or average annual growth rate for that 10-year period was 2%, which is way below trend, which is closer to 3.5. So, and there are other signs. I don't need to kind of go through all of them, but whether it's technical signs such as an inverted yield curve warning us, and then a now uninverted yield curve, a normal yield curve telling us the danger is already here because rates are dropping at the short end, plus a lot of other signs of liquidity and labor being not as robust as we've been told, and other signs all add up to a very serious warning of recession. Now people go, wait a second, Jim, stock market's had an all-time high. It is. I get it. I look at the ticker like everyone else, but who's to say it's not a bubble? People always say, bubbles. You can't call it a bubble. They're really hard to spot. That's nonsense. There's nothing easier than spotting a bubble. Just look at the Nikkei index in 1989, the dot-com NASDAQ 100 composite in 1999, 2000. So bubbles are easy to spot. What's hard is knowing when they're going to pop. That is difficult, and you don't want to run out and short the market just because it's a bubble, because you can lose a lot of money being right. I mean, that you might be right that it's a bubble and you short the market, but that bubble can expand and the market can go higher. In my view, that's the phase we're in. It's going to break and break hard. Don't know when. And I'm not saying short the market. I am saying just beware.
Hey guys, just a quick break to hear from today's sponsor, ARC, Silver, Gold, Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Fantastic breakdown. I wonder how you see gold playing a role up ahead. We've seen great strength, obviously, over the course of the year to date, gold doing very well. There seems like there's a litany of catalysts that could drive gold higher. It's interesting to note that the gold price was doing very well in a high interest rate environment, and now the Fed has started cutting rates. I've spoken to some people who believe that will provide fuel for the gold price moving forward. I know you've put out some pretty big numbers when it comes to the gold price and where you expect it to go. Could you walk us through your thesis there?
Sure. Yeah, I've for a long time, go 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of seventh grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. They have all. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves. But that money is sterilized. It's not doing anything. No one's getting to spend it. And there's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks. And that's M1. It includes bank deposits and so forth. So I use M1. And then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. and 8,133 metric tons. Break it down by ounces, divide one by the other, and sorry, one more assumption. How much gold backing do you want? Now, the hard shell Austrians will say 100%. If it's not, it's leverage, or it's not a solid standard. Historically, that's not true. The Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%. And they ended up at zero by the late 1960s. But it was either 40% or 25%. So take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. So, but it keeps going up, and the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.
Very interesting. I want to get your thoughts on silver as well. Obviously, nowhere near all-time highs. We always hear that in precious metals bull markets, silver tends to underperform in the beginning and then race past gold in the latter stages. There's also the industrial side of silver, which has some interesting characteristics. A lot of people are talking about silver's demand in solar energy. I wonder how you see the setup for silver at the moment.
Yeah, first of all, you're right. I spent a lot of time analyzing gold, not so much from. I do invest in gold mines. I've been in gold mines and know a lot about the production side of the business, but my main interest has always been gold as a monetary asset. The truth is, gold's not good for much except money. I think it's the best form of money. But you say, well, what else can you use gold for? Well, jewelry. Well, okay, jewelry is just a form of wealth that you wear. You see an Indian bride draped in gold chains. It's beautiful looking. Yeah, but that's her dowry. That's her down payment on the house. That's the kid's college education. So jewelry is just just a different way to store bullion. But so gold is not good for much except money. Silver is different. Silver is a precious metal. It can be a form of money, has been, and still is, but it has a lot of industrial input. So when it's an industrial input. So when you're analyzing silver, you've got the precious metals analysis on the one hand, but you have industrial input on the other. And that makes it tricky because if you're in a recession, let's say the price of gold is going up, silver will tag along. Silver will be along for the ride. And you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver.
I want to talk about your latest book, Money GPT, AI and the Threat to the Global Economy. Here's a tweet you made about it. AI is powerful. Finance is pervasive. The combination of the two can be catastrophic. Learn more about the dangers and how to survive the coming chaos. Can you walk us through how you expect AI to have a major impact on the global economy and the chaos it could create?
Sure. The point I make, first of all, the book is not a doom and gloom book. It's has analysis, it has vignettes, it has a couple hundred footnotes. So I never say I may say some things that sound outrageous, but I never say them without backing them up with a lot of research. There's a lot of research behind the book, number one. And it's not doom and gloom. Look, AI is powerful. I was talking about GPT. GPT, generative pre-trained transformers, is a subset of AI. It's a part of the AI world, but it's the part that's getting a lot of attention because, if you give it a prompt, which is a question, it'll answer the question. It'll write an essay. College kids are using it for their term papers. It'll give you images, etc. By the way, I should drop a footnote. I wrote the whole book. It was not written by GPT. You can ask GPT to write a book and it will, but that's not what I did. I did a ton of research, but I make the point that AI is not new. As a scientific discipline, it's been around since the 1950s, but as a form of logic, it's been around since Aristotle. And maybe one of the best examples from the early 19th century was Mary Shelley's novel Frankenstein. Of course, Frankenstein's creature, it was an example of AI. It was artificial, it was put together, but had some intelligence. So yeah, it's been around, and again, it's been developing for a long time. And I've had my first kind of scientific discussions about AI with a consultant from Arthur D. Little in 1979. So that was kind of my first rigorous introduction to it. I built AI models. I built them for the CIA between 2003 and 2014. We built a system for detecting terrorist attacks using market information. I say that the CIA didn't need me to, jump out of a helicopter with a knife between my teeth, but they did need capital markets expertise to do that. They just didn't have it. It wasn't part of the battle space during the Cold War, the post-Soviet collapse. But it was after 9/11 because there was insider trading ahead of 9/11. So if you can spot that and trace it to the source, you could possibly prevent another terrorist attack like that. And we actually built a prototype system that worked brilliantly, and we picked up an early warning of the liquid bomb attack, attempted attack in 2006. So I built AI models. I understand it. It's been around a long time. The first thing I tell people is it's not intelligent. It's called artificial intelligence, good branding. There's nothing intelligent about artificial intelligence. It's all math. It can do stuff. It's powerful. And it can do a lot of good, but it's all math, and that's important to understand. So as it applies to capital markets in particular, the point I make is that there are already some hedge funds out there that are using AI to pick stocks. The managers say, we don't do the research. We can, but AI does it better, faster, cheaper, processing power, speed, etc. And we let the AI pick the stocks. And they've actually had some success. These things are working. The problem is that once you have that phenomena, more and more managers jump in, more and more managers start doing the same thing. And you find that the trades get crowded, the returns go down. It's actually more dangerous than that. I'll explain why, but that's a very typical phenomena. But the point is, all these AI systems are the same. I mean, they may have different developers, different engineers. I'm sure some of the math is different. It's all math, but they all work the same way because they have the same training sets. The training set is a body of material that the computer uses to read, learn how to produce language. Is how GPT, Chat GPT-4 and other apps produce written text. They just go through billions of pages. You can buy the whole internet. That's probably more information than you need, and people use subsets to train your models to do that work and to learn how to write grammatically and logically. So, but they're all the same. And here I refer to something called the fallacy of composition. So what's that? It sounds geeky, but it's a pretty simple concept, which is, let's say you're at a baseball game and you don't have a good view because the guy in front of you is he's wearing a hat or he's too tall or whatever. So you stand up and you say, this is great. Now I can see the game. I can see everything. I solved my problem. But of course, what happens next is the person behind you stands up, the person behind her stands up, and next thing you know, the whole stadium's on their feet. Nobody's better off because you still have the same relative view, and everybody's worse off because you're standing up. So that's an example of a strategy that works well at the individual level that produces catastrophic results at the aggregate level. It's the fallacy of composition being something that works for an individual can be a failure when you apply it on a large scale. Now let's apply that to markets. So let's say you have a market meltdown, and they just happen. I mean, I can name 100 causes, but it doesn't matter. You're in one. So March 2020, the stock market fell 30% in 30 days. It wasn't the biggest crash in history, but it was the fastest crash of that magnitude in history. It had never fallen that far that fast. So what do people do in a market panic like that? Well, a lot of them say, "Hey, we all know how hard it is to make money, but you got to be really careful not to lose money. And what's the point of making it if you're going to give it all back or give part of it back, or you got to start over?" So in a panic like that, people will sell everything, go to cash, move to the sidelines, wait until the bottom's in. Take your time, don't rush back in. But when you see stability return, tiptoe back into the market. That's a very good individual strategy. You'll avoid losses, you'll get a better entry point, and you'll be positioned for gains during the next upturn. A really smart individual strategy. But what happens if everyone does it at once? It's like standing up at the baseball game. If everyone does it at once, you have all sellers, no buyers. The market goes down. You blow through the circuit breakers. The market drops. The indices drop through the floor, and you lose multiple trillions of dollars of wealth because all the behavior is the same. There's nobody on the other side of the market. And, as late as the 1990s, but certainly before then, 80s, 1970s, and going back further, there was a position on the New York Stock Exchange called the specialist. And the specialist had a privilege and also had a duty. The privilege was you got to be the exclusive market maker in a stock. So you were the specialist in American Airlines or IBM or ExxonMobil. You were the only one who got to trade it. And you also got to see the back of the book. You didn't just have the best bid and offer. You saw all the other bids at progressively better or worse prices. But the duty was you had to make a market. So if everyone was selling, you were supposed to sit there and buy to kind of damp down the damage. And if there was a buying frenzy, you were supposed to be a seller, again, to mitigate it. So you were trying to equilibrate the markets to some extent, or certainly mitigate the damage. That system is long gone. I have a friend who's director of floor operations on the New York Stock Exchange. I was down on the floor with him. He said to me, Jim, don't let anyone tell you there's any liquidity here, because there isn't. So where's the liquidity come from? Well, active traders, but active traders are drying up. Everyone's in the index fund. So that's all, at least what I'm describing so far, is human nature. Where does AI come in? AI comes in if we outsource and delegate the trading decisions to AI, and you get into the kind of market panic that we're talking about. AI, if all the systems are the same, and they are, and they all mimic the training set. What's the training set? Sell everything, get cash, move to the sidelines. You end up with all sellers, no buyers. That has happened before, but not at the speed, not uniformly, not with the magnitude. So the bottom line is you're combining human nature, which is prone to panic, with automation, which acts as an accelerant, an amplifier, and you put the two of them together, and you get something that more closely resembles a flash crash, where you blow through the circuit breakers. Okay, 15-minute timeout, fine, but you blow through the next one right away, and the one after that, and then you actually close the markets. And people who say that can't happen, I point out, the New York Stock Exchange was closed for 5 months, from August to December 1914 at the outbreak of World War I. It was closed for 4 trading days after 9/11. What happens when you close the markets? Basically, your stocks that people think, oh, they're liquid, I can trade them, I can get my money and give myself a distribution from the 401k when I'm 70 years old, whatever it is, all turn into private equity. It doesn't mean you've lost your property. It doesn't mean it's zero. It does mean you can't trade it, and you're just stuck in that position. So this is very likely to happen. Again, it's the combination of human nature, which has been around forever, and automation. There's nothing in AI that allow an individual might look at the situation I'm describing and say, it's down pretty far. Maybe this is a good entry point. Maybe I'll tiptoe in. Maybe I'll buy a few bargains. Could be wrong, but people will do that. Computers don't. They cannot do that. They don't have that intuition or gut instinct or whatever you want to call it. It tends to drive the market straight down. I give a scenario of this in the book, in chapter 1 in Money GPT. It's a nonfiction book, but I do have a scenario that I've created to explain and describe exactly what we're talking about. And it has one character is he's a very wealthy family office. So he privately manages his own wealth. He's a family office. Another two traders, very seasoned hedge fund traders in Mallorca, but they're crooks. They're master manipulators, and they want to tank the market and front run it and make money. There's another group. It's a Chinese cyber warfare team. They want to sink the markets, but they're not trying to make money. They're trying to destroy the Western financial system. So they have a geopolitical motive. I have other characters, the Fed chair and reporters and the CEO of the New York Stock Exchange, et cetera. But the story I tell, it follows the outline that we just talked about, where the market goes straight down. But here's the point. There is no mastermind. There was no one person behind it all. The hedge fund traders in Mallorca were not talking to Chinese intelligence. Chinese intelligence was not talking to the private office manager in New York. The Fed was the last to know. There was no coordination among them. But in a complex dynamic system, that's how it works. They're all connected. They just don't know to whom they're connected. And the interaction causes the collapse without a mastermind. So we're much more vulnerable than people realize. I do, Jesse, when I just give scenarios like this, and they're, again, it's not doom and gloom, but it is a warning. I'm warning people, this could happen, and it could happen tomorrow. So you need to be prepared for it. But I never do that without offering some solutions. So one of the solutions I have is called cybernetics. And cybernetics is comes from a Greek word, and the literal meaning in the original word in Greek is the helmsman, the person who steers the boat. And how can you apply cybernetics in the situation we just described? Well, right now we have circuit breakers, which are a blunt instrument. And again, a metaphor here would be, let's say you're driving on ice. And I live in the mountains. I have a place in the mountains, so I drive on ice and snow a certain amount of the time. If you're on ice and you slam on the brakes of the car's not going to stop. It's going to keep going. In fact, it'll probably spin out of control and go off the road. So what do you do in a situation like that if you need to slow down? You pump the brakes. You tap, 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 and keep two hands on the wheel, slow the car down gradually. Don't slam on the brakes. So the equivalent of that in the stock market, instead of using circuit breakers, you could actually have a sliding scale that kicks in fairly early where you throttle the sell orders as the market's going down. So make up numbers, maybe down 5%. You say, okay, so from now on, when a sell order comes in, we're only going to execute half. The order, it could be in the queue. You can come back later, but we're only going to execute half that order. If it's down another 5%, we're only going to execute 20%. If it's down another 5%, we're only going to execute, 10% or less. And you may get to a point where you close the markets with, as we do under the circuit breaker system. But instead of going from full liquidity market crash to boom, slam on the brakes, you'll dial it down, throttle the sell orders, slow it down, give people a chance to think, give public officials a chance to, offer some reassurance, et cetera. That's a better system than slamming on the brakes, which is what we have with circuit breakers. But the other thing I do is I offer investors a suggestions for part of their portfolio, not all of it by any means, but have a slice of precious metals, have some silver, some gold, fine art, land, natural resources, alternative investments, etc. Have a set of assets that are, first of all, hard assets, meaning non-digital. I'm not saying all silver and gold for sure, but have these other things as well. But the point is non-digital assets that are not going to be frozen or seized or caught up in the kind of collapse or vulnerable to the power grid outage. I have all these Bitcoin people. I'm like, how does it work when the power's out? That's a separate conversation. We can take that to the bar. But the point being, it will protect you against the kind of scenario I'm describing. So again, diversify your portfolio in a way that makes you less vulnerable, And for the regulators, think about a cybernetic approach that could be less of a blunt instrument than slamming on the brakes. And that may be the best we can do. But the real best we can do is to understand the danger. Like I say, I'm not saying get out of the stock market. I'm saying I'm warning people these are landmines that you need to be aware of.
Well, let's talk about Donald Trump being elected president of the United States, what you think those potential implications are for financial markets and the economy. Quite interesting that he's got RFK involved and Elon Musk as well. Do you think that bodes well for the free speech question? Because we have seen a lot of attacks on free speech, the EU ramping up, continuing to ramp up a campaign against so-called misinformation, Brazil shutting down X. There's been a lot of examples. The UK police threatening to extradite people from the US and throw them in jail for social media posts, actually jailing people for social media posts, etc. Do you think a President Trump presidency is good for the free speech question, and also your thoughts on how it could impact the markets and economy?
It's definitely a victory for free speech. I'm an economist, an analyst, intelligence, analyst, etc. But I happen to be a lawyer, so I can kind of read the Constitution, and anybody can actually. The Constitution is pretty accessible. But First Amendment says the Congress shall make no law. It does no law, limiting free speech or the right of the people to petition, etc. It's like no law. It's categorical. It doesn't say you can ban so-called hate speech or you can ban certain kinds of speech. It said, no, you can't ban any kind of speech. The solution, there is repugnant speech. There is hate speech. Those things exist. But the solution, going all the way back to, the founding fathers and James Madison and many, many others, is more speech, not less. Somebody says something repugnant, you should be free to say, you know what? That's a terrible idea. It's a repugnant idea. You need to do this. Have the debate. Have it in the public square. Open those channels. And what happens is the better view tends to prevail. It might take a little time, but that's the solution. But when you start banning things, and by the way, whenever I hear the word misinformation or disinformation, my interpretation is that's a government official pointing out something they don't like. Same thing with hate speech. There is real hate speech, but a lot of what people call hate speech is just stuff that they don't like, that they don't disagree with. So it must be hateful because I disagree. But it's usually right. I mean, you go through a long list of things: COVID, masks, vaccines, Ukraine, climate change, etc. The so-called disinformation people had it right. Masks don't work. The vaccines are not vaccines. They're experimental gene modification therapies. It did not stop the spread of COVID. There is, could the climate be warming? Yeah, maybe, but it's not caused by CO2. It's the other way around. Warming climate releases CO2. We probably need more CO2 so the plants can live, et cetera. But if you expressed any of these views, and they're all backed up by good science, by the way, you were the misinformation and you were the ones who needed to be banned. So it's extremely good news. And I think Elon Musk's acquisition of Twitter, now X, but I joined that platform in 2009. So I've been on it for 15 years and seen it grow and seen it morph and twist. And what I see now is a breath of fresh air compared to what it was 4 years ago or even as recently as 2 years ago. Doesn't mean I agree with everything, not by any means. And there's all kinds of clashing opinions, but that's the idea. That's the point. There's supposed to be all kinds of clashing opinions and let people make up their own minds. So that's a huge win for the First Amendment. As far as the economy is concerned, there was very little or no guesswork involved. We know what Trump's going to do. And what he's going to do has been around since 1790. It's called the American system. The American system was invented by Alexander Hamilton. It was supported by George Washington. And over the decades, it was picked up by and expanded in different ways by Henry Clay, John Quincy Adams. Abraham Lincoln was a major proponent of the American system. William McKinley, Calvin Coolidge, all the way through to Dwight Eisenhower. And now there were opponents, the agrarian interests, Jefferson, Madison, they were very much against it. But they failed when they shut down the first bank of the United States. And at almost the same time, you had the War of 1812. They found out that they couldn't finance the war. They pretty quickly started the second bank of the United States because that first bank, which was a proto-central bank, had a lot of utility. By the way, the first bank of the United States, our first central bank from 1792 to 1812, had a 20-year charter. Don't think of it like the Fed. I mean, they didn't print money. They didn't create stimulus. They didn't try to regulate unemployment. They didn't have Humphrey Hawkins. They didn't do any of that stuff, which our current Fed does dismally. It was a pretty simple operation. It was supposed to provide liquidity to commerce on good collateral and good credit, and to the government, so that they could have a form of money that would get the economy moving. And they did, and it worked. It worked very well. But the American system, what was it? It was high tariffs, a central bank of very limited powers to provide liquidity, infrastructure investment, which could be public or private. But the key was that it had to be productive, meaning, in the early 19th century, it was roads, canals. In the late 19th century, it was railroads. Today, it might be 5G or infrastructure, or a digital infrastructure, et cetera, space exploration. But it had to be of a productive kind, or a kind that was stretching the boundaries. We're not talking about government waste, which unfortunately is a lot of what goes on today. And then a strong defense. But again, a strong defense to protect American interests, not to go around the world invading, not to start endless wars, not to conquer territories or get rid of people we don't like, really just to defend U.S. interests. So a strong military with a limited mission to defend America, a central bank with a limited mission, which is to provide liquidity, nothing else, high tariffs to create high-paying jobs and aid U.S. industry, and infrastructure investment, which had to be productive. That was the American system, and it worked brilliantly. This is how we grew to be a very rich, powerful country. It kind of ran off the rails around 1962 with the Trade Act of 1962. That was when, because the globalists had really started after World War I. So this is Hayek and Mies and others in the Austrian school, and many others who wanted open borders, open capital accounts, and free trade. And the idea was, let the whole world act like one market, have price discovery, drive the price down. That's the most efficient. That's a nice theory. It's completely contrary to fact. There's no such thing as free trade. I'm expert on this. When you get into subsidies, non-tariff barriers, et cetera. So free trade doesn't exist. Even if you believe the theory of free trade, which doesn't hold up, it comes from David Ricardo's notion of comparative advantage. It's like, the idea was, England's better at making woolen goods, and Portugal's better at making wine. So it's stupid for England to grow grapes, and stupid for Portugal to make wool. Why don't they just do what they do best in trade? And you can demonstrate that mathematically, and the math works. The problem with that is it presupposes that the factors of production are constant, that England's never going to be a good place to grow grapes, and Portugal's never going to be a good place to make woolens. Maybe that was true, but the factors of production are mobile. Today, for example, Taiwan Semiconductor, largest, most powerful, most advanced semiconductor producer in the world. That started in the early 80s. What was Taiwan's comparative advantage in semiconductors in 1980? Zero. They had none, but they created it. They used something like the American system. They put government resources behind it. They let it grow. They let it thrive. If you were talented and you want to spin off, start your own company, they said that's fine. They sent Taiwanese students to America. They went to Stanford, and then they went back to Taiwan. They were excellent engineers. In other words, and then the capital poured in from the West to expand the industry. So capital was mobile, talent was mobile, technology was mobile. So that obliterates comparative advantage, because you just go where the best environment is, but all those factors can go with you. So and so that's the case for tariffs. It's like, okay, we're going to use government policy to create our own comparative advantage by putting 500% tariffs on Chinese cars. And you're not saying that China can't sell cars in America. What you're saying is, you want to sell cars in America, build them here, build them in America, and then you can sell them. And Trump's going to tear up, was NAFTA, now it's the USMCA, but they're going to target the Mexican companies owned by the Chinese, because China's like, hey, put tariffs on China, who cares? We'll build them. We, the Chinese, will build them in Mexico and import them duty free. And Trump's like, no, if you're a Mexican company covered by USMCA, but you're owned by China, 500% tariff applies to you. That's going to shut down Chinese imports. They're going to have to build them here. By the way, the guy behind this big brain is Robert Lighthizer, who will probably be a cabinet secretary, but he was deputy USTR, trade representative in the Reagan administration. Lighthizer the guy who saved the U.S. car industry from the Japanese invasion in the early 1980s, and he's going to do it again from the Chinese invasion today. And it's one of the reasons Trump did very well with unionized workers. So it's an easy forecast. I can tell you what they're going to do. High tariffs, a lot of infrastructure, high-paying U.S. jobs behind the tariff walls, and rebuild the military, but don't get engaged in a lot of wars. And, trim the sails of the Fed so that it can be a lender of last resort, but don't try to micromanage the economy.
Well, James, this has been a fantastic conversation. Met my expectations, which were very high because I've wanted to have you on the show for a long time now. Fantastic. For people who do want to read your new book, Money GPT, talk to us about that, and also anywhere else you want to direct people online, feel free.
Yeah, thanks. I'm active on X, formerly Twitter. My handle is at James G Rickards. I use the middle initial G. It's my middle initial, at James G Rickards. And the book is Money GPT. It's available for sale right now on Amazon. In fact, Amazon has ranked it the number one new release in finance. So they have a lot of rankings, but by category, we are the number one new release in finance. Got a great review in the Financial Times. They listed it among the best new books in economics. So we're getting very, very kind of high praise from those sources and others. So it's Money GPT, available on Amazon, and I encourage people to read it, and I hope they enjoy it and hope they get a lot out of it. Thank you.
Great. Well, I'll put a link in the description below to Money GPT on Amazon, as well as your X account, so people can follow you there. Thank you once again, James, for coming on and sharing your knowledge with the audience.
Thanks, Jesse.
And thank you for joining us today. Today's episode is brought to you by ARC Silver, Gold, Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.